Hey, it's Coach Hirsch. Today we'll be looking at the Federal Reserve and monetary policy in action. This is section 5 of your BOK. It's a note-taking page, so as I work through this PowerPoint, just jot down some notes and the key ideas. If you have any questions, of course, you can ask me or Ms. Rosenfeld, and we'll be happy to help you. So let's start off with, what is the Federal Reserve? The Federal Reserve, or it's otherwise known as the Fed, is the central bank of the United States. And it was established in 1913 via the Federal Reserve Act. And why did they do that? Well, the United States was growing and the economy was trucking along, and you had a lot of different regions that were starting to interact with each other, and people were paying each other for things, and it was difficult to regulate that, but also difficult to kind of find out what was happening in these areas unless you had some sort of centralized institution that was able to communicate and regulate. So they put it together, and it was set up to ensure that the economy was stable for the nation. So what are the roles and responsibilities of the Fed? Conduct the nation's monetary policy, which we'll get into here in a minute. Supervising and regulating banking institutions and protecting the credit rights of consumers. So basically making sure that banks are on the up and up and taking care of us. Maintaining the stability of the financial system. So obviously when we look at the amount of payments that are made on a daily basis via checks, all this kind of stuff, and loans, whatever, and they're there to make sure that things are stable. Provide certain financial services to the U.S. government, the public, financial institutions, and foreign official institutions. So what does that mean? Well, think of distributing coin and currency to different banks, or who shreds those old dollar bills when you turn them into the bank. The Fed does. Making loans, educating the public, gathering data, all kinds of stuff. So they have quite a bit of responsibility. Whereas our Fed, it's in Dallas. You can see on this map that it's broken down by regions, and all these different regions report back to the main Fed, let's say the Board of Governors you see over here on the right, and say, hey, here's what's happening in these areas, and they start to shape monetary policy, which, like I said, we'll get into here in a second. The Federal Reserve banks, what do? These are the little banks that make up the Fed. So you operate a nationwide payment system. They distribute the nation's coin and currency. They supervise and regulate the member banks. They serve as the banker for the U.S. Treasury. They gather regional, local economic data, which I just said, and then they contribute to monetary policy making through the bank president's participation in the Federal Open Market Committee, which we'll talk about here shortly. So again, the Federal Reserve banks have a lot of responsibilities in their own right. And if I go back, all of these member banks, these Federal Reserve banks, are the ones that are doing all of these things. So they're operating the payment system and distributing the currency and coin, all that kind of stuff. So Dallas has quite a bit of responsibility. Okay, so getting to monetary policy, what does that mean? Monetary policy are policy changes that affect the nation's supply of money and credit. When these policies are put into place, they have real short and long-term effects on the economy. The Federal Open Market Committee, or the FOMC, sets and directs the U.S. monetary policy to achieve 3 goals. And the FOMC is made up of all of the presidents of the banks that we looked at on the map. So they get together and they say, how are things in the Southwest, and the Texas and the Dallas president says, well, here's the data we have. And then the one in San Francisco says, here's the data we have. And they get together and say, okay, well, here's what the economy is doing. Do we want to try to make some changes or not? So the 3 goals are full employment, stable prices, and sustainable economic growth. We know full employment's 4 to 6%. Stable prices obviously means we don't want a rapid inflation. And sustainable economic growth. We want the economy to grow, but we don't want it to go too fast. We don't want it to grow too slow. So there's 3 tools of monetary policy that are kind of referred to quite a bit. The first one being the discount rate. This is the interest rate charged by the Federal Reserve to banks that borrow in a short term, usually on an overnight basis. And yes, it's kind of weird when people think about, like, wait a second, banks are borrowing money from other people. And yeah, it sometimes happens where they need to, they have a massive transaction they're trying to complete, and they don't have enough cash to complete that, so they can borrow money from the Federal Reserve on an overnight basis. Well, the Federal Reserve can raise or lower that interest rate that they charge to those banks. Then you have reserve requirements. This is the amount of money banks must keep on reserve or in the vault at the Fed. So they have to have a certain amount of, a certain percentage of their deposits that are kept over here on the side. So think about Bank of America or down here by Kroger or something like that. They have a certain amount of deposits that are in that bank. And all of those deposits add up to a certain total. They take a percentage of that total, and that has to be kept on the side. So if you raise or lower that total, that affects how much money the banks can loan. And then lastly, you have open market operations. Buying and selling treasury securities, or you might have heard them referred to as bonds, between the Fed and selected financial institutions in the open market. The most important tool, without question, is open market operations, and it's directed by the FOMC. So all of these things work together, and every single one of these things affects the money supply. So if you think about it, when you look at the discount rate, if they charge more money, or they raise the interest rate, it's charging more money to banks to borrow money. So that may mean banks may not want to do that, which can help slow down the economy. And if they lower the interest rate, then banks are more likely to borrow money from the Federal Reserve. So that could speed up the economy and increases the money supply. The reserve requirements, if we lower the amount of money that banks have to keep on reserve, that's more money that banks can loan. If it's more money that banks can loan, it's more money that we borrow. We buy more things, cars, houses, open a new business, all that kind of stuff. So again, if you raise or lower that reserve requirement, you can affect the money supply. You can affect the economy as well. And then on open market operations, you're buying and selling bonds. So if the Fed is selling bonds, that means people are giving the Fed money. If the Fed is getting money, they're taking money out of the money supply. If they take money out of the money supply, there's less money to go around, which means that interest rates go up, which means the economy slows. If the Federal Reserve buys bonds, they're giving you money for your bonds, which means that it increases the money supply, which means the interest rate can go down, which means more people can start borrowing money, which means the economy can grow. So all of these things work together. The last part is just the federal funds rate, and all this is a market-based interest rate that banks charge each other. The Federal Reserve has no real say on this federal funds rate. They can't say, hey, here's what the interest rate is. But what they can do is they can target that rate through buying and selling of bonds. So as I mentioned before, the interest rates go up and down. If the Federal Reserve is selling and buying bonds, or raising and lowering the discount rate, or raising and lowering the reserve requirement, they can affect the interest rate. And by affecting the interest rate, that can help incentivize banks to borrow from each other, or it can de-incentivize them to borrow from each other. So this is another tool, although it's not one that's 100% directly controlled by the Fed. Lastly, let's just talk about interest rates, as I mentioned before. So generally, when you have low interest rates, meaning what it costs for us to borrow, it stimulates the economy because there's more money available to lend. So consumers buy cars and houses, businesses expand, they open up new offices, they buy equipment, etc. So why does the Fed lower interest rate? Well, if inflation is okay, lower interest rates stimulate economic activity and thus boosting economic growth, or as we just talked about in our last unit, it increases our GDP. The effects of high interest rates: the Fed raises interest rates as an effective way to fight inflation. We know what inflation is. Consumers have to pay more to borrow money, means they don't spend as much, means businesses have difficulty borrowing, unemployment rises, and the economy slows. So that's it for this lesson. If you have any questions, like I said, please ask me, or please ask Ms. Rosenfeld. You're obviously welcome to go back and watch this PowerPoint again. The Federal Reserve is a complex entity. Hopefully this kind of made it a little bit easier for you to understand. And good luck the rest of your BOK.